Welcome to the world where inflation rises, capital flees, and crises strike. Currencies tell the story the world cannot ignore. Part 5, Macroeconomics and FX. Chapter 13. Chapter 13, Inflation, Growth, and Exchange Rates. 13.1 Introduction. Macroeconomic fundamentals play a central role in determining exchange rate movements. Among these fundamentals, inflation dynamics, economic growth differentials, and the time horizon of adjustment are particularly influential. This chapter examines how inflation and growth interact with currency valuation in both the short run and the long run. 13.2 Inflation indicators and exchange rates. Consumer Price Index (CPI). The CPI measures changes in the price level of a basket of consumer goods and services. Persistent inflation differentials across countries are a key driver of long-term exchange rate movements. According to purchasing power parity (PPP) theory, currencies of high-inflation countries tend to depreciate over time relative to those of low-inflation countries. Empirical evidence shows PPP holds more strongly in the long run than in the short run. Producer Price Index (PPI). PPI captures price changes at the production level and often leads CPI. In open economies, rising PPI, especially in tradable sectors, can quickly impact export competitiveness and currency valuation. Wage data. Wage growth reflects labor market tightness and productivity. When wage growth exceeds productivity gains, inflationary pressures increase, often prompting tighter monetary policy, which may support the currency in the short term. 13.3 Economic growth differentials. Currencies are strongly influenced by relative growth performance. Higher growth rates attract foreign investment through higher expected returns, increased foreign direct investment, FDI, portfolio capital inflows. However, growth driven by excessive credit expansion or fiscal imbalances may weaken a currency over time if sustainability concerns arise. 13.4 Short run versus long run exchange rate effects. Short run. Dominated by capital flows. Sensitive to interest rate expectations. Influenced by risk sentiment and speculation. Long run. Anchored by inflation differentials. Productivity trends, Balassa-Samuelson effect. Structural competitiveness. Empirical studies consistently find that macro fundamentals explain exchange rates more effectively over longer horizons. 13.5 Key takeaways. Inflation is a long-run determinant of exchange rates. Growth differentials influence capital flows. Short-term FX movements often diverge from fundamentals. Long-run currency values tend to revert to macroeconomic equilibrium. Chapter 14, Trade Balances, Capital Flows, and FX. 14.1 Introduction. Exchange rates reflect the balance between a country's external payments and receipts. Trade balances and capital flows together form the balance of payments, BOP, a central framework for understanding currency dynamics. 14.2 Current account dynamics. The current account includes trade in goods and services, income flows, transfers. A persistent current account deficit implies reliance on foreign financing, often leading to currency depreciation if investor confidence weakens. Conversely, sustained surpluses can support currency appreciation, although reserve accumulation and policy intervention may offset this effect. 14.3 Capital account and financial flows. Capital flows are typically more volatile than trade flows and include portfolio investment, foreign direct investment, banking flows. Exchange rates are often driven more by capital account movements than trade balances, especially in advanced financial systems. 14.4 Capital flow volatility. Capital flows respond rapidly to interest rate differentials, risk perception, global liquidity conditions. Sudden reversals in capital flows can generate sharp currency depreciations, even in countries with sound trade fundamentals. 14.5 Sudden stops and currency crises. A sudden stop occurs when capital inflows abruptly reverse. Common triggers include monetary tightening in advanced economies, loss of investor confidence, political or financial instability. Such events often lead to exchange rate collapses, reserve depletion, banking and sovereign debt crises. 14.6 Key takeaways. Capital flows dominate short-term FX movements. Trade balances matter more in the long run. Sudden stops are major sources of FX crises. External sustainability is critical for currency stability. Chapter 15, Global Crises and Currency Behavior. 15.1 Introduction. Global financial crises reveal the behavior of currencies under extreme stress. Exchange rates during crises reflect liquidity needs, risk aversion, and shifts in global capital allocation. 15.2 Asian Financial Crisis, 1997 to 1998. The Asian crisis highlighted vulnerabilities related to fixed exchange rate regimes, short-term foreign debt, weak financial supervision. Currencies such as the Thai baht and Indonesian rupiah experienced massive depreciations following capital flight. 15.3 Global Financial Crisis, 2008. During the 2008 crisis, risk aversion surged. Global dollar funding shortages emerged. Safe haven currencies appreciated sharply. The US dollar strengthened despite originating from the crisis, reflecting its role as the world's primary reserve currency. 15.4 COVID-19 Shock, 2020. The COVID-19 shock caused extreme volatility in FX markets, a temporary dash for US dollar liquidity, massive central bank intervention, unprecedented monetary expansion altered traditional FX relationships, emphasizing the role of policy credibility. 15.5 Safe haven currencies. Safe haven currencies typically include US dollar, USD, Japanese yen, JPY, Swiss franc, CHF. Academic research attributes safe haven status to deep financial markets, strong institutions, credible monetary policy. 15.6 Key takeaways. Crises amplify capital flow dynamics. Exchange rates reflect global risk sentiment. Safe haven currencies strengthen during turmoil. Policy credibility is critical during shocks.